Sometimes I think about how would I have invested in 2019 if I had all the knowledge I have right now. Just a quick background of the first years of my investing journey, it was really all over the place. I was the first stock investor in our family, actually in the whole clan, so I had no one to teach me. I didn't know where to begin, what should I read first, and so on. After I started working January 2019, I hadn't yet begun investing because I had no clue at all. The first vehicle that I got to invest in was a time deposit in a mutual fund, which was one of the biggest mistakes I made during that year, but more on that later. I only had the guts to open an account in June 2019 after some months of reading, watching videos about investing, and trading. Though I know for myself I wasn't ready, because the knowledge I have I'm not sure was enough because it was all mixed. I didn't have yet a sound strategy like dividend value investing. I was just there to invest in popular stocks like Jollibee, SM, Ayala, and Metro Bank, the ones I always see in my everyday life. I had that mentality that if it's popular, it will surely go up in time. I just cost average in those stocks every month. I made all the mistakes any investor can make during that time. Luckily, I didn't stop reading books and listening to value investors online. That is where I honed and came up with a strategy that really fits me, which is what I use now, dividend value investing. So for this video, I want to share the things I wish I would have done earlier in my investing career so that you can learn from my mistakes, especially if you're a beginner investor. The first thing is patience, a lot of it. Now this is a broad topic, so stick with me as this is very important. Because back then, I had that mentality that if I didn't invest in this stock right now, I would be left behind. That FOMO effect, fear of missing out. Today, I've learned that there's always another investment out there, and no one even knows if it will continue to go up or come crashing down. I can just imagine it if I didn't have this mentality before, though I think most newbie investors would fall into this trap. But if I just waited back then, or just invested in another stock, then my portfolio right now would have higher returns. Be patient when buying stocks. If your guts tell you that the stock is already overvalued, then do further research first. Do not fall into the trap because it's popular and you're afraid that you're missing out on something big, which puts us to the next one. Analyze first what you're investing in. That's why for me, do not listen to content creators or paid groups that just show you stock recommendations without even showing any research at all, just showing their thoughts, their projections without any evidence at all. Or just simply do your research first before pressing that buy button. I fell for those in my early years, and I regretted it so much when I learned about the finances of those companies that I was actually buying an overvalued company. However, doing research does not guarantee that you prevent yourself from investing in losers, but I can tell you right now, it will give you a higher chance to get good bargains to prevent you from bigger losses, which I have experienced so much. If I took out those early investments I made, my portfolio's return would exponentially be higher because I was blindly investing in companies back then. I just followed the advice of investing in what you know, but I failed to really understand this principle. Do I really know it? Have I researched the company enough to proclaim I really know it? It's just like having a crush on a popular artist. You know them by their looks and what they show on TV, but can you confidently say you know them? Same in stocks, you know the company by name, but do you know what happens within the company, their financials and everything? I tell you, there are a bunch of companies here in the Philippines that even if you didn't try, you would know them by name, but when you do research about them, you'd be shocked as to how bad the company is really doing. Though again, this does not guarantee that all your investments will win, but it will give you a higher chance to pick good investments. I know 5 years of investing isn't enough to say that, but in just these 5 years, if I took out those investments back then, my portfolio would have been so much better. It was so obvious. Just by looking at its simple ratios and a quick look at the financials, I just wish I didn't invest in those. Now before we go on to the next one, a quick detour as to how you can analyze stocks easily is a great platform to add to your investing tools is simply Wall Street. They have filters to quickly search for potential companies to invest in, a portfolio tracker, a watch list, and a lot more. The way they present their data is so clear and easy to understand, even for a beginner investor. So if you want to try it out, they offer their basic plan forever free. And if you want to avail of their paid plan, then use my link below and get up to 40% discount. Thank you, and back to the video. Another one related to analysis and is the most important part that I learned so late. I think I got this lesson a year and a half into my investing journey when I read Phil Town's book, Rule Number 1. It is margin of safety. I put that in all caps. This alone would have saved me from most of the negative returns in my portfolio and would have boosted so much my returns by a landslide if I had known this earlier. Proper research and margin of safety alone, I tell you, would improve your investments so much if you don't take into heart all that I'm saying right now. This one, nail to your mind and heart. Never invest in a company without a margin of safety. No matter how good that company is, if you don't have a margin of safety, chances you'd buy it at a very high price. Now, in my portfolio, Megaworld, if you look at my first portfolio reveal, I was already down big with Megaworld. This company, I believe, is very strong in terms of financials. Right now, they have already recovered their pre-pandemic level and is continuing to grow its business. Their dividends is growing along with their earnings, so analysis-wise, it is a great company. But my biggest mistake back then was when I first learned how to compute the intrinsic value of a stock. I was very excited. I feel like I found the secret formula in investing, and Megaworld was the first company I used it on. But the problem was, when I computed their intrinsic value, I didn't know that when you do, you should have a margin of safety, because no matter how great the formula is, you are just projecting the growth of the company. You do not know if there's an impending problem ahead, like a pandemic perhaps, or if the company would continue to grow in that phase as you projected it. So there may be errors in your calculation, but a margin of safety gives you a cushion effect if ever the computed intrinsic value is very high or wrong. If the stock falls after you buy it, at least you gave yourself some cushion to fall onto. Imagine, I was buying the company at its peak because in my computation, it was still undervalued. Had I put in that 30% margin of safety, as I always show in my stock analysis videos, I wouldn't have bought it back then at its price. Yes, I'd still be negative, but I wouldn't be buying at that high range. Imagine, even my stock analysis video 3 years ago, with a 30% margin of safety, my buy below price would only be 3.30. And I was buying beyond 5 pesos. I computed it. Had I learned this lesson before, though I'd still be negative, but only by 10 to 20% after dividends, maybe even lower. This is a true story. It was only at year 1.5, I think, when I started to use the intrinsic value formula and the margin of safety you see in my videos. I was so down when I recomputed all the stocks in my watch list. If only I had bought Phil Town's book earlier. So for beginners, read Phil Town's Rule Number 1 book. It's 900 pesos I think in fully booked back then. It will definitely pay for itself. You know, I had a lucky friend that when I had finalized my strategy, I gave her a copy of my buy list. It is a list of the stocks I researched that has all the computed intrinsic value and buy below price. Her portfolio is doing better than mine. It is a copy of my portfolio, but a better one, as she didn't experience my first mistakes. I'd be honest with you, I had that idea back then for my first portfolio reveal, which was my first video on this channel, to show that portfolio because my portfolio was negative at that moment. But anyway, it would defeat the purpose of showing my journey, and I'd be lying big time if I had done that. I think even my brother's portfolio is better than mine, as he also copied what I invested in when I started this YouTube channel. Next, I wish I had focused on dividend stocks earlier. If you've watched finance content creators in other countries, you would often hear the terms stick to growth or value stocks. Some even say don't invest in companies that pay dividends because it's better for the company to just reinvest it. Warren Buffett isn't a fan of companies paying dividends. That's why his company Berkshire Hathaway hasn't paid a single dividend over its lifetime. Yes, it's better for the company to just reinvest it and let the company grow, and it would eventually lead to its price appreciating, which is said to be higher than what you get from dividends. But I learned these past years, and if you trace down the performance of our market, the Philippine market works differently. One I think is the reason for our market to be a laggard, we don't have much participation locally. We have such few local investors, leading to less liquidity. Second, we rely so much on foreign investments to drive prices upward. Since the Philippines doesn't have a lot of tech companies, even if other non-tech companies here have good growth in their finances, if it's not popular, its price would remain the same and may even go down as foreign investors withdraw their money as they are focusing on tech stocks in other countries. You can see this, the revenue and earnings of companies in the PSE index have already surpassed pre-pandemic levels years ago and are already booking record earnings, yet the market cap is still down big. So by knowing these things, that our market tends to lag for years, and even when companies post higher financials, it still stays down and is a laggard. So what will drive your portfolio's returns? Dividends. When stock prices are down, you get higher yields. Combined with a company recovering already and recording higher earnings, the chances are it will deliver more dividends the next time. Even in the S&P 500, when tech stocks weren't yet driving the market to the moon, there are decades where dividends were the biggest contributor to gains. So just imagine it here. Though there's not much research about it, I can assume dividends have been a sole contributor to gains for decades now, and even in other decades when a PSCI lagged for years, like in the early 2000s. And I can even see it in my portfolio. 95% of my gains come from dividends. You can also see this in indices. The dividend index beat the main index, the PSCI. For me, I wouldn't be relying so much on that theory of investing more in growth companies here, or companies that are strong but do not pay substantial dividends, as our market does not react the same way as the US market. And the best part about dividend play here in the Philippines, there are a lot of great companies with a high dividend yield because prices are still down, and the Philippines is already transitioning to a more dividend-friendly market. The 20 pesos minimum fees for trades has already been removed, which DRAGONFI, my broker, has already adopted. I think it's the only broker that has done so far, so if you haven't yet opened a DRAGONFI account, you're missing out on all the tech it gives and all the benefits it provides. Open up an account right now using my link below, and both of us can get up to 1,500 pesos. Anyway, this means easier reinvestment of dividends, which will activate that snowball effect immediately with lower fees, and the dividend tax rate is still at a very low 10%, no matter how high your dividend income is. So while waiting for the price to appreciate, which we don't know when it will happen, you're still earning a lot of money. And even if prices lags for years to come, when you reinvest dividends, it will compound and compound, letting you earn money as you wait patiently. It's a win-win situation. This was my biggest mistake as I was starting. I wish I just focused on great companies that are undervalued and pay a fair amount of dividends consistently. Back then, I was investing in any great company that fits my criteria, even though it doesn't pay substantial dividends. This is also one factor that cut my gains a lot. Had I concentrated on dividend stocks as early as possible, my gains would have increased, and also my monthly passive income would have been substantially bigger. And you can also see dividend stocks here perform better. Lastly, I wish I knew more about fees back then. As I said, the Philippines just removed the minimum fee of 20 pesos per trade. Back then, I was buying stocks with 800 pesos, 500. Imagine, I was paying 2.5% per trade. That is a 1 year's worth of dividends for some stocks, and that's not all. I mentioned a while ago, I also invested in a mutual fund. I invested in an equity fund that tries to beat the index. The annual fee was more than 2% per annum, and the worst part of it, that fund underperforms the index, so I'm paying more for their underperformance, wherein if I just invested in an index fund like FMETF, I would have paid less than 1% per annum. So fees do not just apply for investing in stocks, but also if you're an index investor. Research first the fund you will invest in and compare it to other funds that offer the same investment and compare its annual fees. These small fees would cut your gains a lot in the future, as fees also compound. I eventually sold that mutual fund, by the way, when I knew how outrageous their management fee is. And the funny thing is, the advisor that sold me that fund, which she was an advisor for more than 2 decades, I think she had the longest years of service on their website, as you can choose there which advisor you want to meet up with. I wouldn't name the company, but she didn't even know the management fee when I asked her about it. My goodness. So those who are buying funds from these advisors, just test them and ask more about the fund they are selling and the management fee. Just test them if they really know about the products they sell. Anyway, the same for when buying individual stocks. Right now the PSU removed the minimum fee, but they didn't put it as a mandatory rule. Back then when someone asked me if brokers are a big deal, I just answer it's all the same, as long as it's legit. Now with this new update, it is a big deal. Find a broker that has the lowest fees and is legit, of course, as this will not only aid your strategy as you can reinvest dividends easily or reinvest money from selling stocks without worrying about paying a lot, but also can aid your overall returns in the future. As I said, fees compound as well. So those are the mistakes I made in my early days of investing that I wish I could have prevented, though I'm lucky that I managed to build a strategy that suits me before I create a bigger damage to my portfolio. But again, the learning just continues. Knowledge also compounds. And that's why I'm sharing with you guys my journey. As for those who have the same situation as me, they have no mentor and they don't know where to start, well, maybe you can learn from my mistakes. Add it to the books you read, as my YouTube channel is a sneak peek experience of the Philippine stock market. With that, I hope you learned something, and if you did and still haven't clicked the like button, then I'd appreciate it if you do so before leaving. Thank you and see you in the next video.